things that people were doing right to get deductions. Like, for example, like one of the things that worked for me was I bought a $4 million commercial building, an apartment complex, and I got something called accelerated depreciation, and that actually helped me tremendously. Hi, everybody. This is Joseluiz Morales. Welcome back to the Morales Group Show. This is episode number 68. Today, we've got a very special guest. His name is Larry D. West. He is the owner of Precision Tax Planning. He is a tax strategist and tax specialist. Today, he's going to be sharing with us some of the mistakes, some of the winning strategies, and how to approach taxes as well, too, so that you don't end up with some expensive mistakes. I know that happened for me back in the day. I had a couple years where I paid too much in taxes. So after that, I became a fan, which is why I'm excited about the show. Welcome to the show, Larry. How are you?
I am doing well. I'm doing well. Thank you for the opportunity. And a lot of people run into that, right? The tax thing, because tax is not a sexy subject, it's kind of kicked down the line until either the tax bill shows up or the IRS sends a letter. Then it becomes very interesting.
Yeah, it's funny because I started somewhat on the right foot as it related to taxes. I hired somebody who wrote a book on tax strategies, but essentially I realized that there was a lot more that she wasn't telling me at that point. And then at that point, I hired a different person, and then basically started investing myself into tax education. So let's just start off by, who is Larry West? How did you get into tax planning? And how did you end up in the investor real estate field as well, too?
Yeah, absolutely. I'll try to take the 3-hour movie and kind of condense it into just a couple minutes here. I really got my start in education, right? That's where I was going when I came out of school. And I tell this story all the time because it was a bit of a humbling experience, considering now, even though I'm in the tax space, I still use education as kind of my primary focus in terms of how I teach tax to the business owners that I work with. But anyway, I left education pretty quickly because, quite honestly, it just didn't pay enough, and it didn't pay fast enough for me. Yeah. And so I went back to business school, and then I had this cool idea that because I thought I was super smart, I was going to come out with my MBA, University of Wisconsin, and go ahead and go into investment banking, right? Six figures right away coming out of school. And let's just say that didn't happen. I ended up getting a job at a investment firm in Milwaukee, where I'm from. And I was specifically working in the tax space at that investment firm. And what I realized at that point was, my light went out here. But what I realized at that point was, for all the investors that were wealthy, if they didn't make their money in the real estate space, they sure as heck protected their money in that real estate space. And a lot of them did so for tax reasons. And at the time, I didn't understand it. But the more and more I learned, real estate presents some phenomenal tax opportunities. And so I grabbed that bull by the horn, and that's where I really cut my teeth in terms of understanding tax strategy, not just prep, right? Because tax prep is, let me tell you all the stuff that you should have done last year. And the strategy is more of, these are the moves that you can make today to give you some amazing tax savings, not just now, but in the future. And that's why I really built my career around. I love the strategy side of it. And then real estate just becomes one of there's almost nothing like it in the tax code that gives you ability to have a solid asset that appreciates over time, gives you favorable tax advantages. And then, at least as the rules stand right now, you can pass to the next generation in a very tax efficient way.
Yeah, no, to be honest, I am such a fan of real estate. I mean, I've seen the benefits, and it's interesting because when I got started in real estate, I didn't understand all the tax benefits that really real estate provides. And I almost feel like a business owner and real estate go hand in hand. Like, literally those two, like if you're a business owner and you own real estate, you can have tremendous tax benefits by owning real estate that can actually benefit your other business, even if it's not real estate related. So we're going to get into that at some point towards the end. But let's just start off, like, I'm a business owner. I'm starting my own business, or I'm starting a real estate company, like I'm starting a flipping company or a holding company. How does somebody determine like what should they be doing, or is there an entity that those people should be in? And also, like, is it almost like get started first before you set up all these entities and all these expenses, and maybe don't do anything with it? Because I also see that as well too, where people almost get paralyzed by setting up all these entities, and they got all the right entities, but they never end up doing anything with it. So what advice would you give there?
Yeah, quite a few things that initially come to mind. And I say this in every single workshop that I do, every single talk that I give. A couple of things folks need to understand. Number one, how you make your money influences how that money is taxed, and how that money is taxed will give you an indication of what type of entity structure you should have to best protect yourself against taxation. So, two different sides of real estate. For those that are on the wholesaling, fix and flipping, development, what the IRS calls a dealer, those that are on that side of real estate, that income is subject to what we call ordinary income tax, which is basically your federal tax, the 800-pound gorilla based on your tax bracket. And it's also subject to this pesky little thing we call employment tax, said differently, FICA, said differently, Social Security and Medicare tax. That's 15.3%. And so, as we're having the conversation about entity structure, that's one of the things that we're trying to help our clients mitigate against is the employment tax.
Mhm.
So, typically, and again, I always preface this by saying, nothing we talk about is specific tax advice for any one individual, but usually the having your entity structured as a subchapter S corporation gives you the best opportunity to mitigate against employment tax. There are unique things that happen when you have that type of a structure that allow you to avoid that 15.3%. So for those that are on the fix and flip side, like I said, wholesaling, dealing, or even outside of real estate, those that own a business that's a service-based business, or they sell products and things like that, they typically benefit from an S corporation. Now, on the other side, going back to real estate specifically, for those that buy and hold real estate, whether they're doing short-term rental or long-term, you buy the asset, you plan to hold on to it for the long run. That usually makes more sense to hold that asset in an LLC. And you do so simply because you don't necessarily have the fight to help to try to reduce your employment tax. Real estate real estate income, rental income already has that favorable tax treatment. So it usually doesn't make sense to go towards a corporation unless there are some other unique things going on. So having it held inside of an LLC is usually the best bet, and it's done so mainly for liability protection, not necessarily tax planning. Because whether you hold it personally or inside that LLC, your tax situation isn't going to change. So those are the key things that we usually start out with. How are you making the money? That tells us how it's going to be taxed. That then tells us which entity you're going to go with. And usually they're floating between those two. Now, that's not the end all be all. There are tons of other entity structures out there, but that's kind of the basics in getting started.
So in other words, if you're buying and holding, the real estate actually already provides the tax benefits. And for those people that don't know what the tax benefits of holding real estate are, Larry, what would you say the tax benefits are?
Yeah, so there are a few, and forgive me, I was grabbing the cord here. I want to get this light back on. I look like one of those anonymous people that don't want their face shown and just giving out information. But in any event, the tax benefits that come along with buying and holding real estate. Number one, we hear this a lot: depreciation. So I like to describe depreciation really in layman's terms. And some of my tax friends will get on me because I'm not going to use technical jargon here. But depreciation is kind of a gift from the IRS that says, hey, you purchased this asset. We're not going to allow you to write off the full price of it right away in this first year. You have to chop that up into 27 and a half if it's residential, 39 chunks if it's commercial. So you take the purchase price, you divide it by one of those numbers. So let's assume it's residential, right? You got a $500,000 property, 27 and a half years. The IRS says, thank you. We're going to give you an $18,000 deduction every year. That's an $18,000 paper deduction. That's not actual money that's going out, right? So your cash flow, it really helps because your cash flow is intact, but you've got $18,000 that you can take in without any tax implications.
Yeah.
That's the fun part. And plus you got your other operational things, right? Property tax and some of those other things that happen. So that's the first thing. The second thing from and this is less of a tax, but just more of a
Right.
appreciable asset perspective. One of the best things that real estate does for you when you own the asset, it allows you to an extent to hedge against inflation. What happens as the value of the of things go, or excuse me, as the price of things go up, the value of the dollar, you can usually raise rents in tandem to help you hedge against that. And then again, as things currently stand, because there are tons of proposals right now by President Biden, but you can pass your asset on to the next generation after something happens to you, and they receive what's called a step up in basis. That means you bought the property at, let's use a $500,000 mark again. You bought the property at $500,000. Over the time that you've owned it, it's now appreciated and it's worth $750,000. At the time that you pass away, your family members receive that step up in basis. They now have a property that's worth $750. If they decide to, they could sell it with limited capital gain exposure. So that's one of the fun things that happens on the tax side with real estate.
Yeah, it's funny because in other words, like if you make $18,000 of positive cash flow a month, that's money in your pocket. But then if you have $18,000 of depreciation, that wipes out, to my understanding, the entire $18,000 that you made, and
Exactly.
it makes it so that you don't pay any taxes on that. So, and towards the end, we'll get into some more advanced tax strategies like accelerated depreciation, and not only
Yes.
how we can wipe out some of your cash flow, but it could also wipe out some of your income from your business as well too. The other thing I was going to ask you is, let me play devil's advocate on this. So if somebody was flipping properties, and instead of being in an S corp, they're in a LLC, how would I know that you said the self-employment tax? How would that look different from a tax perspective?
Yeah. So yeah, that's a really good question. I'd like to model that out using $100,000 example because it keeps the numbers simple around. So let's say we have someone who's fixing and flipping properties, and after all their expenses, they net $100,000, and they're doing this under an LLC. They haven't made any type of election to be any type of corporation. When that tax return is done, they're going to have $100,000 of taxable income. So that's going to hit their federal tax bracket. Let's just assume that comes out to 20%, just as an example. That's a $20,000 tax bill, right? Then employment tax happens on top of that. And remember, that's 15.3%. That's another $15,000. So now we're at $35,000. And, we haven't even talked about whether or not they're in a state like California, Illinois, New York that has a state tax, and a couple of other things that could be levied in there. So by the time they look up, half of their profit could go out the door to taxes, and which is why tax planning is important. So just a simple change in entity structure. Let's juxtapose that with an S corporation. If they had done so under the S corporation, we could have set it up. And again, this is purely as an example. Let's assume their net profit is $100K, right? The S corp requires one of the officers to have a reasonable compensation. That means a W-2 wage. So let's imagine we carve them out at a $40,000 W-2 wage. Okay, they still made $100,000. They just made 40 from a W-2, 60 from their business. So they still made $100,000. They still owe the $20K, but that $15,000, instead of paying 15% on $100,000, they've now only paid 15% on the $40,000. So that probably gives you roughly a $6,000 to $7,000 savings right there. And again, for my accounting friends and my tax friends out there, they're going to say, hey, there are all kind of steps in terms of the tax ladder. There are all kinds of calculations in terms of how the employment tax. We get it, but this is simply to demonstrate the power of the S corporation and how you can save taxes just by making the right entity election. And then we haven't even gotten into the cool strategies, the more advanced stuff that they could do.
Yeah. So essentially, it's only taxed on the profit, right? Like both entities are only taxed on the profit. Meaning, if let's say you flip a property and you make $100,000 and you invest 80,000 back into the business, so the net profit's only 20. You would only get taxed on the 20 for either one. It's just that the S corp has the self-employment tax on top of, or no, the LLC has the self-employment tax that the S corp have, in other words. But the S corp requires that you be on a salary, right? Like, can you have an S corp without being on a salary?
No, one of the requirements for the S corporation is that an officer of the company must take a reasonable salary. And that's where the fun and the strategy comes in, because there's no hard and fast definition on reasonable. Now, there are court cases that talk about what reasonableness is, but there's no hard and fast rule that says it has to be this percentage or this kind of a split and different things like that. So you get to have a little bit of flexibility there. And you really look at it for someone who's providing services for the company, right? This is usually the owner. If you're the CEO, right? The chief everything officer. So you look at it from this perspective. What would I reasonably pay someone to run my company? Again, if I got a company that brings in $200,000, am I going to pay somebody $150,000 to run it? Probably not. So reasonableness is a bit subjective, and it's based on how much you're earning and the services that you provide. So again, you get to have some flexibility there, and it allows you to an extent to hedge against the employment tax.
Yeah, that's awesome. So what would some of the strategies be there that would actually be a benefit? Is it beneficial to have a higher salary, or is it beneficial to have a lower salary? Like, let's say that the $200,000 company, they wouldn't have the, is it a benefit to have a higher salary than a lower salary? I guess that's the question. And it sounds like it would be. At the same time, you have to be reasonable with that amount, in other words, right?
Well, no, I think the better opportunity is the lower your salary is, the more that you win, because the less amount that's actually exposed to employment tax. Because when you do the S corp, only the salary is exposed to employment tax. Everything else is just your federal tax bracket. And so there are a few reasons why you would want a higher salary. One, if you somehow believe that Social Security will be there by the time you reach that age, then you want to start paying into Social Security. For many people, they don't believe that's going to be the case. The other reason is there may be some retirement account planning that you're doing that requires you to boost your salary a little bit so that you can put more into a retirement account. There may be some couple other reasons, but those are usually the two main reasons that you would want to hire one. Outside of that, everyone is going to be trying to push that salary as low as possible. But again, it has to be reasonable. And you know, reasonable is again a bit subjective based on how the company is performing.
And then I think when I got started, because I have an S corp for my real estate company, when I got started, I think that my accountant recommended that I take it was a study, or there was a company that I could look into for them to tell me how much was a reasonable salary for myself. What would you recommend if somebody is looking to determine what a reasonable salary is for their business? How would you suggest they arrive at that number?
Very simple. Talk to your tax advisor, your CPA, your EA, your accountant, whoever advises you who's ever qualified and advises you from a tax perspective. Talk to them, because they'll have the experience of at least seeing a broad range of companies and advising you on what they think is defensible if an audit ever sprung up.
That's awesome. Now, for different types of businesses, let's say a restaurant, let's say internet, like Amazon, selling a business on Amazon, or some type of retail business on Amazon. Do those typically go under S corps or LLCs, or what does that typically look like? Just out of curiosity.
Yep. So those are very similar to where we started, similar to those folks that are doing wholesaling, fix and flipping and things like that. Those kinds of activities are subject to employment tax. So they tend to do better if they're under a subchapter S corporation. And again, there are other entity structures that they can introduce that may be beneficial for them, depending on what their entire tax world looks like. But usually an S corporation is going to be a really good choice to help them save on tax.
How do we know whether something is subject to employment or self-employment tax? Like, is there like a differentiating factor in that?
Yeah. So, it depends on the type of activity that's happening there. If things are active, meaning you actually have to do something to make a dollar, then that typically is going to be subject to ordinary income tax and employment tax. Things that are inherently passive in nature, meaning whether you roll out of bed or not, you're still going to make that money. Those are usually have passive activity attached to them, and they're not subject to it. Now, there are all kinds of nuances in that, so you always want to run it by your tax professional to make sure that they advise you correctly. But that's a general way to look at it, because when you think about real estate, if I fix and flip, if
Mhm.
I don't roll out of bed and go hunt down a deal, I'm
Yeah.
not getting paid. So that there's a lot of activity involved in it. Self-employment tax. If I have buy and hold rental real estate, I'm a landlord. Whether I roll out of bed or not, that rent is getting paid on the first, hopefully, right? So that's a little bit more passive in nature.
That's awesome. Okay, cool. I learned, obviously, I don't do flips very much, but I actually have my flipping company under an LLC, which means that it would benefit me to switch over to an S corp, but then I don't do that many flips enough to probably make it worth having a salary and some of those other things associated with it as well, too. Which is why I think at the beginning I set it up as an LLC. Now for the rentals, they're all under LLCs, but I liked how you broke it down to you get the tax benefits regardless. The only difference is the liability protection because,
Mhm.
in other words, you gave me the understanding that you're going to get the benefit regardless. It's just, are you protected or are you not protected? How
Yep.
important is it for somebody to be protected in that regards? Like, have you seen people get sued when things happen at their properties? And what are some of those stories that maybe you could share with us?
Yeah, absolutely. But before I jump into that, I want to just touch on something really quick that you had mentioned, because I think it may be really valuable for the audience members in terms of your specific fix and flip business. It where your volume of transactions are doesn't justify the changeover. So I want to talk about really quick what those metrics are, or at least what we advise clients on
I
when
love
they're on that side of that business, and then I'll jump into some of the liability stuff because some crazy things have happened. So determining whether or not it makes sense to make the election to be treated as an S corporation. You have to understand the extra compliance that comes along with it. Usually, one, you're going to have an extra tax return that's filed every year, so you got to factor in the cost. And most places are 750 to 1,200 bucks.
Mhm.
You need to have a very good set of books. So either you're doing it yourself or you're paying someone to do your bookkeeping, but that's usually going to run a couple $1,000s a year.
Mhm.
And then you also have the officer compensation and payroll, which typically takes on an additional cost. And so all in on a conservative side, you're looking at $3,000 to $6,000 a year in compliance costs to have a after S corporation. Now, you compare that with the tax savings that you'll get when you make the transition. Our magic number has been somewhere around $40,000 to $50,000 of net income. It makes sense to go ahead and make the transition. Of course, anything above that is kind of a slam dunk, but that's really what you'll want to look at. The extra cost that I have to take on, 3, 4, $5,000 a year. Will I get 3, 4, $5,000 in tax savings by doing this? If you don't, then it typically doesn't make sense because it's kind of net net. And if you do, then it's a no brainer. So hopefully that's helpful to someone out there. But your question about liability, this is one of the things where I say all the time, tax and legal must have open doors of communication.
Mhm.
So for investors out there, for business owners out there that are building their team of advisors, make sure your attorney and your CPA, EA, or accountant always have communication to talk to each other, because as they're making recommendations, one all typically impacts the other. So liability protection when you have the real estate and the LLC, what you're typically exposing is your equity inside of the property. Okay,
Mhm.
so $100,000 property, you put X amount down, you've owned it, and you've built up some equity in it. Someone slips and falls. Sure, you may have a insurance policy that covers you, but what happens if they just so happen to have savvy or maybe even an overzealous attorney who wants to try to find a way to punch through that policy and take you for everything that you got. If you own it inside of the entity, well, just the entity is exposed, right? Limited liability. That's the name. If you own that personally, well, now your personal assets are exposed. That's you, that's your bank account, that's your personal home that you own. All these other things that you have under your name could be exposed. And that's why you want that LLC there to provide a buffer between you as the individual and the operations of the business. And the same is true going the other way. What if you as the individual do something goofy and now you've exposed the if things aren't set up appropriately, you now expose the operations of the business or the assets that you own that are for business purposes. So that LLC provides a lot of liability protection. So I'm not an attorney, don't pretend to be one, but that when I talk to my attorney friends, that's usually what they're discussing.
Mhm. Perfect. Yeah, and a lot of people, a lot of times, don't think about that. They don't think about the liability, or they think that that'll never happen to them, or that it's never happened to somebody. But the reality is, it does happen, and it is something to A, have a really good policy, and then B, make sure. Now, for somebody that has, like, let's say, 10 properties, I know some people recommend to put them in sets of three, like three properties, three properties, three properties. Some people say just put each one in a property, because if they fall in one of the properties, then all three of your properties are exposed. What are your thoughts on that, just out of curiosity?
Yeah, I like to group it by aggregated risk, right? How much are you willing? How much can you stomach to lose? So, because when you say numbers and you group them in three, well, I mean, you could have 100,000, 500,000, and $1 million home. That's a lot of risk to group together. So I like to look at it from a perspective of your
Risk.
equity inside of these properties. How much could you stomach to lose? So, if you've got $20,000 of equity across three properties, that's $60,000 aggregated together. Don't see a problem grouping those things in terms of the exposure there. But if you are very, very risk averse and you're like, hey, I want everything to be separated, then the separate LLCs start to make sense. Some states, Texas being one of them, some states recognize what we call series LLCs, which is a very cost-effective way to have a parent company at the top and a bunch of subsidiaries, or they call them baby LLCs underneath. Not every state recognizes that. So you certainly want to talk to your attorney and your CPA to see what is the best way to set that up in your particular state.
So almost like Morales Holdings, and then each different LLC underneath that. Perfect.
Yep.
Okay. Good. What are some of the other mistakes, like, let's say, not in regards to liability? What are some of the other things that you've seen as it comes to tax planning? I know for me, and I'm open to sharing this, one of the big mistakes that I made was not tax planning back in 2017. And I got hit. I mean, I flipped a couple properties, made this income real estate related, and I got hit because I failed to tax plan. What are some of the things that typically, what problems do customers typically come to you with, in other words?
Yeah, good question. Sorry, I had to plug in the computer before it died. My apologies. But so typical problems that they come to, the one you just mentioned is probably the most obvious one: failure to tax plan. Because you get into the ebb and flow, you got a couple of deals going. It's like, I'll get to that, I'll get to that, I'll get to that. December 31st rolls around and it's like, oh crap, I haven't done anything. And there's not a lot that can be done if you don't do things before the end of the year. So failure to plan is a huge one. Entity election, as we talked about already, is another one. But the biggest one is really not understanding that as a business, you'd have now opened the door to have all kinds of amazing deductions that you would normally take on as personal expenses, but now they truly have a reasonable and customary business purpose. Cell phones being one of the more obvious ones, mileage from your vehicles, travel. I mean, we could go on and on. I kid you not, the number of tax returns that I review every month and the number of missed opportunities that are on them easily into the five figures, right? 10, 15, $20,000 worth of deductions simply because they're not aware of the opportunities that are in front of them. So those are some common things there. And then, perhaps another one of the bigger offenses is you try to do everything on your own and screwed something up and you got a letter, and now we have to fix it.
Mm-hmm. Yeah. So one of the mistakes would probably be trying to do everything on your own, basically.
Yeah.
In other words. Okay. And then let's talk about like some of the like winning strategies. Basically, like, so let's talk about things that people are doing right to get deductions. Like, for example, like one of the things that worked for me was I bought a $4 million commercial building, an apartment complex, and I got something called accelerated depreciation, and that actually helped me tremendously. So would you mind elaborating on that? And then also maybe elaborating on a few other things that maybe aren't as obvious that your customer or people are doing to benefit in terms of taxes.
Yeah. So the one you mentioned is a very, very useful and powerful tool, accelerated depreciation. But how does it happen? So when you own a real estate, especially when you own commercial buildings or even larger multifamily units and things like that, this becomes phenomenal. But the cost segregation study is the gateway to having a lot of that accelerated depreciation come through. What is that cost segregation study? We talked about depreciation. It's when you have the purchase property, the purchase price divided into X amount of chunks, and that's the deduction that you get to take every year. The cost segregation study comes along and it says, well, hold on, pump the brakes. We know there are pieces of this building that are not going to last 27 and a half or 39 years. So we need to segregate, hence the name segregation. We need to segregate those components out. Things like air conditioning, roofing, some of those other pieces that we know we have to replace within a, 5, 7, 15-year time frame. It segregates them out and then reclassifies their useful life. The whole building has a useful life in commercial for 39 years, but these different components can be reclassified and have either a 5, a 7, or a 15-year life. That's the cost segregation study. Now, accelerated depreciation, or some people call it bonus depreciation, under the Tax Cut and Jobs Act from President Trump, said that, hey, these particular classes, you don't have to wait the entire 5, 7, or 15 years to depreciate them. We'll allow you to take the whole deduction right away in the first couple of years. So imagine that, a $4 million building, which you would normally spread out over 39 years, probably somewhere around 1.5 to 2 million of that can be accelerated and drops on the first 3 to 5 years. That completely changes your tax situation. Yeah. $1 million deduction right there. Easy.
Yeah. And that's exactly what happened to me. I even sent it to some friends because basically just to give another example, let's say you make 500,000 in your real estate business. And let's say you get or let's say you make $1 million in your real estate business. And let's say you get $1 million deduction. It basically wipes out the entire gain for federal purposes, not for state purposes, right? For federal purposes, which means that if you have the paper loss of $1 million and you made $1 million, it means for federal taxes, you, in other words, wouldn't pay any taxes. So for me, that was a big, like, mind blown because I'll give you another example, Larry. My dad brags to me. He's like, well, I have a ranch. And because I lose money on that ranch, I get a write-off because I lose money. And then I told him, I'm like, Dad, that's a physical loss. You're actually losing the money, meaning money is coming out of your pocket. Versus a paper loss. On a paper loss, it's just on paper. You didn't actually lose the money. It's basically a write-off. Now, what would be some of the classifications in order for somebody to qualify for this? Because I think you have to qualify as a real estate professional. And can anybody in any business do it? Like if I'm a doctor, can I use accelerated depreciation? If I'm a restaurant owner, could I use this as well too?
Yeah, great question. This is one of my favorite things to talk about during our workshop is to break down real estate professional status. We call it reps. So the backdrop and the rules. real estate is inherently considered passive in nature by the IRS. By default, it's passive income, and the losses that are generated from depreciation and operating this real estate are considered passive losses. Only passive losses can offset passive income, right? So those two things have to match up. Many people don't fall into that category because they have a ton of other things going on. They have either a regular W-2 job or substantial involvement in another business, tons of things, right? So they have a lot of active income. And then if they do real estate, they have a lot of passive losses. Those two things can't immediately offset each other unless you qualify, as you mentioned, as a real estate professional. So how do you meet that qualification? There are three things that you got to be aware of. Number one, you need to spend at least 750 hours in real property trade or business, materially participating in real property trade or business. What's real property trade or business? Real estate sales, broker, property management, development, all these different areas that we traditionally think of. So at least 750 hours in this space.
Question. Does that mean that if you're a real estate agent and you spend over 750 hours selling real estate that you automatically qualify?
No, you meet that first threshold of the 750 hours in real property trade or business, but then you also have to make sure you hit these other two that I'm going to talk about. That you got to have this whole thing. And I'll tell you also, real estate agents and brokers are notorious for violating this because of that assumption. So the second thing is more than half of your time needs to be spent in real property trade or business. That means more than 50%. So for those, as you mentioned, that are doctors or have a substantial business that they operate in different things like that, it's really hard to justify that you're spending more than 50% of your time doing real estate related things, right? Because you got a full-time job.
Yeah.
So you got to check the box on those two. And then the last thing is you need to materially participate in your rental related activity, not the rental related activity of someone else. So that's material participation in the actual properties that you own, right? And we'll have to kind of dig into material participation, but you got to have all three of those boxes checked. And that right there opens the door for you to use those passive losses from real estate to offset active income. Here's where realtors and brokers tend to go wrong. Is they make the assumption that because I'm selling property and that's what I do full time, I automatically meet the threshold. But they forget that last part, material participation in your own rental related activities, not the rental related activities of someone else. So as long as those things are true, then they can they're in a position to use those losses to offset their active income.
So let's go back to the doctor and the restaurant owner. What if your wife is a real estate agent and your wife basically spends more of, like, let's say one spouse is a doctor and the other one is a real estate agent, one of the spouses? Would that meet that threshold? Would that be easier to justify one of the spouses spending the 750 hours in that, or more than half of your time in that department?
Yeah, so that opens the door. If the primary taxpayer doesn't meet the threshold, then yes, your spouse can meet that threshold as long as all those same things are true that we just walked through, and you all file a joint tax return together. If you're filing separate tax returns, well, then everything is reported separately. But if they're joint, then it all flows through on 11040, and yes, you can use that. That's a great way that a lot of our doctor clients use that.
Yep. Now the last part is material participation. So like, let's say that like somebody like me, let's say I own 57 units. We self-manage all 57 units, approximately $12 million worth of real estate. Right now we self-manage everything. But let's say that I wanted to maybe diversify a little bit and invest with like a syndicator. And let's say there's a syndicator offering for the investors to keep all the depreciation, almost just for a tax haven.
Yes.
Let's say that I invest $1, they're going to give you $2 back in depreciation. would that cause a problem? Like if I did that, since I have a sizable real estate portfolio, more than 750 hours of management, would that cause any problem, or would I be able to write that off? Basically, let's say I invested 300,000 in a year, and I got 600,000 in depreciation back from that investment. Is that something that would be allowable?
So that's a great question. And I tell you, tax professionals fight about this one all the time. There are a lot that are on the side of the aisle of no, you're considered a limited partner. You're not actually investing in real estate itself, so it doesn't meet that threshold. And there are some that suggest that you can aggregate, as long as you make the election to aggregate all of your rental activities together and treat them as one, then you should be okay. What I'm going to say, I'm not going to give a direct answer because I don't want anyone to make assumptions. What I'm truly going to say, and I think people beat up on us when we say this all the time, talk specifically to your advisor to see if that makes sense for you and if it's something that they think is defensible in the event of an audit. I have seen where you're a limited partner inside of a syndication and you meet the qualifications for being a real estate professional and you elect to aggregate all your activity as one, where some people will then take those losses, whether they're limited, losses from that syndication deal that, like you just mentioned, or your actual real estate that you own, and treat that all as one. But I've seen other people who says, nope, that's not right. You're going to get audited and you're going to lose. So talk to the tax professional, see if that makes sense for you. And yeah.
For your clients, what is your response?
Well, it depends on their unique situation and what we think is defensible. If the facts and circumstances suggest that that aggregation works and we have the code section to back it up, then we're going to go for it. As long as we believe we can reasonably defend it in an audit and win. And of course, the client has to be on board with this as well. So that's the one thing that's important. They ultimately sign the tax return saying, I agree with everything that's on here. So as long as those two things marry up, then we'd go for it.
It's funny because when I first reached out to my accountant about it, he said no, and then he did some more research, and then he said yes. And I think that's what you were referring to in regards to, is it a coin toss? But these are like more advanced tax strategies. Now, let's say that somebody didn't have a sizable real estate portfolio and just wanted to invest with a syndicator, and they were a limited partner versus a general partner. In that case, is it less likely that it would be defensible?
Yeah, it's going to be less likely in that regard because you have the burden of material participation. When you're a limited partner, it's really hard to meet material participation. Now, there are some unique ways to do so. They're not easy or can be done without proper guidance, but it can be done. But that's going to be the big drawback there is if all you're doing is investing in syndications as a limited partner, you can't really meet the material participation part, then none of it falls into place.
And then what happens if I forgot what I was going to go. Okay. So let's go into, and I love this topic and I'm so grateful. I don't know if anybody has ever told you this, but you have a really good way of explaining things in a very simple way. And it's almost like I could tell this is not your first time explaining some of these things because you have like perfect examples for everything to make it very simple. So I appreciate that, and obviously interviewing you. So let's say that we don't go into cost segregation. What are some of the other things that people can do to help them in terms of taxes? Maybe like if a vehicle is over 6,000 pounds, maybe what else are people doing, or what else can help different business owners to help them?
Yeah, so for most of our business owners, and again, specifically for our real estate folks that are doing the fix and flip development, wholesaling side of things, who have active income or said differently, earned income, then the vehicle deduction is a powerful one. But I have a little bit of a rant that I usually go on. I'll condense it for the show here. I like the vehicle deduction. I like, a lot of people use that as a flex, especially when we're talking about business credit and different things like that. That all makes sense. But I caution you to understand the implications that come along with it. Number one, if you're going to write the whole thing off, 100% of that vehicle needs to be used for business purposes. The moment you have any of the personal use attached to it, you've now overstated your deduction and kind of exposed yourself. So as long as it has 100% business use, then let's do it. Let's go for it. If you qualify, let's get it done. It's a great tax deduction for vehicles that are over 6,000 pounds, i.e. a G-Wagon. If you want to go get one of those, it allows you to accelerate that depreciation and write off most, if not all of that right away in year one. And you don't have to spread it over 5 years. The other thing, retirement accounts are low hanging fruit for tax deductions. So there's pre-tax and post-tax, but most of us have been in W-2 jobs where we have 401ks with match provisions and all of that. When you're a business owner, you can create that for yourself. And they're really, really powerful if you're a solo business owner or you just have a smaller crew, you're a really lean business. Larger organizations, that gets a little bit hairy. But you can effectively put up to $57,000 in a retirement account. You can then take that a step further using things like defined benefit or cash balance accounts to go from 57 potentially up to a couple $100,000 of a deduction that could go into these different types of retirement accounts. We also talked about the deductions that you take on that now, because you're a business owner, have business use. One that people typically forget about is travel, right? You're the business owner. We talked about being the chief everything officer, right? Chief of marketing, chief of finance, chief of HR, chief of everything. So if you just so happen to like Maui as a destination, and there's an HR conference in Maui, and you need to go there so you can be a better leader for your employees, then go, right? It has a business purpose. Register for the conference. Your travel and lodging and some of the other expenses associated with that trip could potentially be a tax deduction as long as it's documented appropriately. And by the way, you're in Maui, so there's that too. So I mean, the list goes on and on. There are so many different things that people could do to plan. One other one that I love to talk about: hiring your kids. That's a great way, especially if you have more than one, to pile up a pretty sizable deduction. Now, documentation and rules still apply, but as long as your kiddo makes less than $12,550, and this is for 2021, so you could pay them $12,550, and they have no federal tax implications, and if done correctly, they have no employment tax implications. So imagine that. I get a $12,550 tax deduction. My kid gets that money and there are no tax implications. What happens if they roll, let's call it $6,000 into a Roth IRA that grows tax-free over time? That's a lot of money that no one's paying taxes on, right? And it's allowed because that's how our current tax code is set up. So all that to say, a number of ways to slice this thing up, and which is why it's important to do some planning.
Yeah, exactly. So, and I think that's the lesson or the message that we want to pass on to the consumers is just whatever you do, just make sure that you tax plan and talk to somebody that can help you strategize. Because if you don't, in other words, there may be some. There was a year where I made $500,000 and I paid over 300,000 in taxes. And I was like, man, like 500,000 you not gave away, but over 300,000 went away. Yeah. I was like, it was so painful. It was one of the most painful experiences of my life, I would say, just because it was like, man, all this hard work literally just gone. Had I known about some of the strategies that I know now, obviously that would have saved me a lot of money. I wanted to ask you another question. So let's say that somebody does the syndication, and let's say they get $100,000 in deduction, and let's say they make $100,000 on a flip. I know those are different classifications. One of them's active, and it sounds like one of them is passive. Does that matter at all, as long as they're a real estate professional, or is that kind of like would that be allowable? Would that help as long as you had that depreciation? That depreciation would still help you.
Yeah, so the key in that example is, do they qualify for real estate professional status? If they do, then that's a perfect scenario. $100,000 flip, $100,000 loss, those two offset each other. On paper, in terms of taxation, you made $0 and you can't tax zero. But in real life, you got $100K sitting in your bank account to go out and do it all over again. And that's wealth building right there.
Yeah, because it creates that snowball effect where now you've saved 100, now you've got $100,000, you invest it again, then again, and then again, and then it almost starts to spiral. Now, the last thing that I wanted to touch on is just changes. So here's one of the things as well too. Like if you tax plan today, that might be different from 6 months from now. That might be different from a year from now. It might be different from 2 years from now. This is not like a one-time type of thing. This is something that's ongoing, and meaning like I've got a great relationship with a loan officer. Obviously, she helps me and kind of tells me how things run. I would say that an equal important relationship would be with a tax consultant, somebody that you can run things by and say, hey, look, what about this? What about that? Would this fly? Would this not fly? What are some of the changes that are being proposed right now and that could potentially happen that could basically change the entire dynamic? I would say, because there's a lot of different changes that are potentially, there's talks about a lot of changes. Can you elaborate on some of those and how that would impact? And then if those went away, is there any other solutions for people to still benefit?
Yeah, absolutely. I tell you a few that are being discussed heavily in the real estate space, and then I'll talk about some broader ones. Everyone's concerned about the 1031 exchange and what's going to happen. And for those that aren't familiar with it, the 1031 exchange basically says, hey, I have a property and I'm going to sell it. And as long as I agree to buy another property or properties of equal or greater value, I get to not pay taxes on the one that I just sold. So it's almost like I get to trade up without any tax implications.
Yeah.
What they're discussing right now, and a few different iterations of this proposal are on the table, is for anyone who has gains, capital gains in excess of $500,000, which are typically going to come from larger single family units or multifamily or commercial units, right? But anyone who sells those kinds of properties and their gain is higher than $500,000, you're going to be limited in how you can use that 1031 exchange. Either you can only use it to offset partial amounts of the gain, or you just can't use the darn thing at all, depending on how large your gain is. Yeah. And that's going to impact the transactions that we see happening. Some people are going to decide to hold on to property because they don't want to pay the large tax, or some people are going to bite the bullet and just have to pay a pretty sizable capital gain tax. So here's the thing that I say about that. One, all speculation right now. We have assumptions on what we think reasonably will pass and what won't. But what if that does, worst case scenario, that exact iteration goes through? It is going to just expose some of the alternative things that we've already been doing from a tax planning perspective. With gains that large, there are tons of different vehicles you could look at. The opportunity zones become a bit more attractive because they allowed you to shield some gain, and they have a tax-free component at the end. We can get into that. There's the deferred sales trust, which basically allows you to so if you and I were going to do a transaction and we have a price that we decided on, I'm gonna go and form this deferred sales trust. I'm gonna sell the property to the trust for, let's call it $500,000, right? Mm-hmm. The trust isn't going to give me any money right away. So if I haven't received money, there's no gain to recognize. It's then right at closing going to turn around and sell that property to you. So now you as the buyer got your end property. The trust doesn't have any capital gains implications because it bought it from me for $500,000 and sold it to you for $500,000. So it nets out to zero. And when I set this trust up, I decided on a specific payment schedule that I'm going to receive funds in whatever amount. That could be $100,000 a year for 5 years, or whatever type of iteration that is inside of there. So now I only recognize a gain on the amount that I receive in a given year. Instead of paying taxes on $500,000 today, only pay taxes on $100,000. So that's a smaller tax bill. And my other four gets to stay inside of the trust and start to do other things to earn more appreciation and more value. So it's a great way to continue to invest and have gains, but pay limited capital gains on the transaction we just did. So opportunity zones, deferred sales trust. There's also the Delaware Statutory Trust. That's an option. And I can go on and on. The point here is there are going to be alternatives to the 1031, and it's really going to impact those that are doing larger transactions. For everyone else, it's kind of business as usual. So not a lot of panic there. We are hearing about. Actually, let me pause there because that was a lot. Any specific questions on any of that?
So you touched on two things. One of them was opportunity zone, because what I love about my job is that, like, I'll talk to clients, and then clients will pitch different ideas to me about what they're doing in their business, and then that'll give me the opportunity to look into certain things a little bit deeper. So one of them, the first question I had was the Delaware Statutory Trust. Don't you have to exchange into a Delaware statutory trust? So wouldn't that, like, it be eliminated if the 1031 exchange got eliminated or up to a certain point?
Not necessarily. So you do have to you do exchange into it. So it's a great alternative to the 1031 and even a great supplement to the 1031 exchange, because basically the 1031 says you have to buy like kind property. So that means you got to trade real property for real property.
Yeah.
The Delaware Statutory Trust basically gives you real property. It gives you a direct ownership into an underlying property that is cash flowing. So it's almost like you're buying into a syndication without a lot of the hairy things that happen on the syndication side. So for those who do 1031s and who can't meet the full replacement threshold that they need to meet, that's a good supplement. Or for those who just don't like the time frame of a 1031, that statutory trust becomes a good supplement.
Yeah. And then it sounded like the trust item that you mentioned, it sounds like it's similar to a 10, like almost like it would be an alternative to a 1031 exchange almost, right? Like you set up the deferred trust, and then it sounds like it almost accomplishes the same exact thing, or does it?
Yeah, so kind of. It kind of does, but it's more similar to an installment sale. So, and people do this all the time in business. I'm going to go buy $1 million business, but I'm not going to give you $1 million right away. I'm going to give you 200,000 a year over 5 years, right, to help with cash flow and things like that. So the deferred sales trust is a great mirror of that. It basically says, I'm going to sell this property, so you, the end buyer, will still get the full property, but for me as the taxpayer, I'm going to chop up the segment, the amounts of money that I receive every year, so that I can control what my capital gain is going to be. If I don't want to pay capital gain on $500,000 today, I'll just chop that up into small segments and pay capital gains on 100, and I can handle that a little bit better. But the cool thing is, the remaining amount inside of the trust, it's not just stagnant; it's also reinvested into other things, so it's continuing to earn while you're deploying the other capital that you got in other places.
Now, the last question that I had in that subject is, this is what the client told me. The client told me that one of the strategies other investors are using is that they are selling properties and 1031 exchanging them now into opportunity zones. And then if you exchange them into an opportunity zone, that the opportunity zone allows you not to pay capital gains or something like that. So he didn't go into full detail. He just kind of pitched it to me, but like I almost felt like when he told me that, like a light bulb just went on, like ding, 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 and I was like, wow, like this is brilliant. Would you mind elaborating a little bit on that, and if that's factual or not factual, and how people are implementing that?
Yeah, absolutely. So I tell you, opportunity zones, they came about with the Tax Cut and Jobs Act, Donald Trump's tax plan from 2017 that went into effect in 2018. And that was one of the lesser known or lesser publicized things, but now it's receiving so much more publicity, and the time frame around it is important too. So here's the framework. I can sell an asset, anything. It could be property, or it could be a business, or it could be stock. It could be a comic book that I sold. The point is, I got a capital gain, and I don't want to pay taxes on that capital gain. I can roll that into what's called a qualified opportunity fund. And when I do that, it allows me to defer the tax that I would have paid. So instead of paying taxes today, I can kick that tax can down the line for so many years. And once I get to the point, and it's 5 and 7 years were the original markers, but because of where we are in terms of the timeline, it could be a little less than that. But the original plan was, if I defer for 5 years, I get a 10% step up. in my basis. So instead of paying taxes on that amount, when 5 year hits, I can pay taxes on 90% of it instead of the full 100%. That's a win because not only did I hold on to that money and it didn't go to the IRS, it was reinvested and earning for me. When I do pay taxes, I only pay taxes on 90% of it. If I hold it for an additional 2 years and I make it to 7, well, then I only pay taxes on 85% of it. So I can get a 15% kicker at that point. At that point, though, taxes due, right? IRS is saying, hey, look, you owed us a couple years ago. We let you slide. We want our money now. So you got to pay taxes eventually on what you sold, okay? But the new thing that you bought inside of that opportunity fund, if you hold that new purchase for at least a decade, 10 years, and you decide to sell it, no capital gains tax, no depreciation recapture, you can walk away completely tax-free. And it ain't a lot of things that the IRS give you that are tax-free. They do a lot of tax deferral, but tax-free, this is one of the limited things that you can do that with.
So basically, and is there a way on the property that you sold, is there a way to get more than 15% step up in basis almost? Or not 15%. So it's instead of paying 100% of that gain, you're only paying 85%. Is the 85 the lowest number, or does it go lower than that?
No, that's the lowest, the way things are written right now. And again, based on the timeline, we may not even be able to hit the 7 year mark because I think that expires in 2026, which only kind of gives us 5-6 years ish based on where we are today. So for those that did this a year or so ago, then they have that opportunity. For everyone else, you kind of stuck at that 10% mark.
10%. So eventually, if you knew that you were going to be liquidating your real estate portfolio and you knew that you weren't going to 1031 exchange, or you thought that the 1031 exchange was going to go away, it might be a good opportunity for you to look into a qualified opportunity fund.
Yep.
And then you would be saving on the property that you're selling. Those taxes are going to be due, but then you would also be setting yourself up where if you invest in a property and you buy it at $1 million, over the next 10 years it appreciates at $2 million. Now that entire $1 million is tax-free completely.
Tax-free completely.
Instead of holding on to the property that you currently own and for the next 10 years and then selling, you're going to be subject to capital gains on the entire gain if that property goes up as well too. You know what's funny? There was an apartment complex that investors bought in our area for like $70 million. And I looked at it, they remodeled it perfectly. And I thought to myself, wow, that was a lot of money for this apartment complex. And then when this client told me about the opportunity zone, I looked into it. It fits right into that opportunity zone. Now, I'm pretty certain that their thoughts were exactly what you're describing right now, that they're thinking about it maybe as a liquidation of their portfolio maybe in 10 years or so. And that would, in other words, help them.
Yeah. And, here's the other thing that for folks to keep in mind, too. It's I don't want to downplay it, but it's not necessarily a tough thing to start your own qualified opportunity fund. You have to self-certify, and there are some really heavy compliance rules that you have to follow. But if you talk to your tax professional or someone who specializes in setting up opportunity funds, I think many of the listeners would be surprised how easy it is to do so. So if you're going to do development work or buy and hold real estate and all those other things, especially if you're going to court investors, does it make sense? Because these investors are selling things all the time. They need a place to park their money to offset gains. Does it make sense to have a qualified opportunity fund that invests in opportunity zones, just like that project you mentioned? That could be a win.
Yeah, it could be helpful for all of the parties. Good. Is there anything else that you think we should add? Or anything else? Obviously, I mean, this is a topic that you and I can talk about for days, and I'm glad that I had you on because I've learned obviously a couple of very important things. Is there anything else that you think that we should add as it relates to the changes, or anything else as it relates to tax strategies?
Yeah, the only other thing is not so much a specific tax advice. It's just more of a suggestion. If your CPA, your EA, your accountant, whoever you're relying on for strategic tax advice, if you're not meeting with them more than once a year, then you're doing this planning thing all wrong. In fact, more than 2, 3, 4 times a year should be sufficient, because things are dynamic. You need to make sure they are abreast on the changes that are coming down the line, and especially if you're a higher income earner, what things can you do now to prepare in case those things happen, or the moment we know what's going to happen, what can you execute? So the planning meetings are absolutely important. So force your advisor to have those sessions and those meetings with you.
Last question: if because there's talks of the bonus depreciation going away as well too, right?
Mm-hmm.
Let's say that we invested with a syndicator and got a $500,000 write-off, and let's say we did that today. If there's some changes happening at the end of the year, would that still help, or would it just be too late because they would make the change retroactive or whatever?
It's possible that they can make it retroactive. Status quo has been, when tax laws are put in place, that they don't necessarily go back and are retroactive to the prior year. They're just for that particular date going forward. However, there are not many, there are a few times history has shown us where some administrations actually make those things retroactive. I mean, we saw it with some of the stuff in 2017 with the Tax Cut and Jobs Act. And a lot of that stuff, too, we're still trying to figure that out today. We've heard proposals from President Biden that the increase in capital gains tax could be retroactive to his announcement in April of this year. So there is a possibility that things could be retroactive. We just have to continue to watch and see what happens. And regardless of what side of the aisle you're on, planning just became that much more important.
If it's retroactive and the investment is today, it would be retroactive for the entire tax year, or would it be retroactive, like meaning if the investment gets done today, because you meet, like let's say it goes into effect September 1st or November 1st, would that mean that you get the write-off because you made the investment today, or no?
It depends on how they draft it. Under normal circumstances, whatever the effective date is going forward, as long as you got things done before that, you should be under the old rules. But we've seen folks break those old rules, so it could go either way.
Wow, good. Well, you provided tons of value. Obviously, I learned a lot. Thank you so much. This was episode number 68. Last thing, if people wanted to get a hold of you, how can they get a hold of you?
Yeah, so a couple of different ways. One, you can visit my website, which is simple. It's LarryDWest3.com. So LarryDWestIII.com. Or follow me on social media channels. All of them are titled Larry D. West III. We hold discovery meetings just for folks who want to have consultations. And of course, we hold strategy meetings as well.
Great. Now, to the viewers, if you haven't subscribed to our YouTube channel and you like the content, make sure to hit that subscribe button. If you saw enough value with what Larry provided, make sure to hit that share button. Larry, thank you so much once again. This was episode number 68 of the Morales Group Show. I appreciate you coming on and kind of sharing all your expertise and knowledge.
Awesome. Thank you. I really appreciate it.